Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Ingersoll Rand Inc. Annual Report. Ingersoll Rand Inc. offers a diverse range of businesses and services across various industries worldwide. The company operates in two main segments: industrial technologies and services, and precision and science technologies. The Industrial Technologies and Services segment provides equipment and solutions for air and gas compression, fluid transfer, power tools, lifting equipment, and other specialized products under brands such as Ingersoll Rand, Gardner Denver, Nash, Compare, Elmo Rachel, and others. These products cater to various markets including industrial manufacturing, water and wastewater treatment, chemical processing, clean energy, food and beverage, agriculture, and more. The Precision and Science Technologies segment designs and manufactures precision pumps, gas boosters, hydrogen compression systems, automated liquid handling systems, odorant injection systems, controls, software, and other related components for applications such as medical, laboratory, industrial manufacturing, water treatment, chemical processing, clean energy, food and beverage, agriculture, and more. The company sells its products through a network of direct sales representatives and independent distributors. In summary, Ingersoll Rand Inc.'s businesses and services include air and gas compression equipment, fluid transfer equipment, power tools, and lifting equipment, precision, pumps, gas boosters, hydrogen compression systems, automated liquid handling systems, odorant injection systems, controls, and software, other related components, and accessories. These products cater to various industries including medical, laboratory, industrial manufacturing, water treatment, chemical processing, clean energy, food and beverage, agriculture, and more. Unfortunately, I do not have access to the text you provided. However, I can still provide a general overview essay on what could cause an increase in stock price for Ingersoll Rand Inc. In recent years, companies like Ingersoll Rand Inc. have seen their stock prices fluctuate due to various market and economic factors. One possible reason for an increase in stock price is the company's ability to adapt to changing market trends and consumer demands. If a company can successfully pivot its products or services to meet emerging needs, it can lead to increased revenue and profitability. Another factor that could contribute to an increase in stock price is the company's financial performance. A strong balance sheet, steady cash flow, and increasing earnings per share can all contribute to a higher stock price. Additionally, if a company has made significant investments in research and development or has expanded its operations into new markets, it may also lead to increased investor confidence and a subsequent rise in stock price. Furthermore, external factors such as changes in government policies, economic growth, or industry trends can also impact a company's stock price. For example, if a company operates in an industry that is experiencing high demand due to government regulations or technological advancements, its stock price may increase accordingly. In conclusion, the reasons for an increase in Ingersoll Rand Inc.'s stock price are likely multifaceted and influenced by various market and economic factors. By understanding these underlying drivers, investors can make more informed decisions about their investments. Ingersoll Rand Inc. market capitalization of $39 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that Ingersoll Rand Inc. holds a significant advantage in their industry. Ingersoll Rand Inc. trades at a higher price-to-earnings ratio of 67 times and a lower price-to-book ratio of 3.78 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 43% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The net income of the company experienced a significant decline between 2024 and 2025. The net income decreased by $257.5 million, representing a 30.6% drop. This decrease was also reflected in the quarterly results, with a $170.3 million decrease in Q2 2025 due to goodwill impairments. However, there was an increase of $12.7 million from 2024 to 2025, indicating some improvement. The profit margins also underwent changes during this period. The gross profit margin decreased slightly from 43.8% in 2024 to 43.6% in 2025. On the other hand, the operating income margin and net income margin experienced a more significant decline, decreasing from 18% to 15% and 11.7% to 7.7%, respectively. The adjusted EBITDA margin showed an increase, however. The reasons behind these changes are multifaceted. Currency, exchange rate fluctuations, and uncertainty around AI development had a negative impact on the company's performance. Additionally, goodwill impairments, input cost inflation, product mix, acquisitions, and foreign currency impacts on adjusted EBITDA also contributed to the decline in net income and profit margins. Restructuring charges and changes in foreign currency gains and losses on intercompany notes and hedges further exacerbated the situation. The company's financial performance indicates a consistent trend of generating positive operating cash flow over the past 3 years. As per the provided data, net cash provided by operating activities has been steadily increasing, with figures of $1,355.7 million in 2025, $1,396.7 million in 2024, and $1,377.4 million in 2023. This positive trend suggests that the company is efficiently managing its operations to generate sufficient cash flow from its core business activities. The company's financial health has undergone significant changes in terms of its debt level and interest expenses. A review of the extracted summaries reveals that the total debt has increased from $4,754,400,000 to $4,783,300,000 between 2024 and 2025, resulting in an increase of $28.9 million. Furthermore, interest expenses have also seen a substantial rise, increasing by $40.7 million from $213,200,000 in 2024 to $253,900,000 in 2025. This represents a significant jump of 19.1% in just 1 year. The increase in debt level and interest expenses suggests that the company is facing financial challenges and may need to reassess its borrowing strategies. The data from various pages confirms this trend, with multiple sources indicating an increase in both debt levels and interest expenses. While some minor discrepancies exist between different page numbers, the overall picture is clear. The company's financial situation has deteriorated significantly over the past year. The performance of various segments and regions in the company's operations has been mixed. On the positive side, industrial technologies and services and precision and science technologies have performed well, driven by strong demand environments and favorable trends respectively. The former segment saw a 7.2% increase in orders and 4.1% increase in revenues, while the latter experienced a significant surge of 14.1% in orders and 12.5% in revenues. The EMEIA region also performed well, with a notable 28.8% increase. The United States region saw a relatively modest 0.5% increase. On the other hand, several segments and regions underperformed. Precision and science technologies was an exception here, as it had previously been performing well, but underperformed this time around with a minus 3.9% decline. Corporate and other segments suffered significantly, with a minus 21.6% decrease. Other Americas and China also underperformed with plus 31.4% and minus 1.7% increases respectively, although the former was from a low base. The other Asia-Pacific region saw a plus 35.1% increase, but this too was from a low base. Management's primary focus is on helping customers achieve maximum uptime, reduce operating costs, and improve sustainability. To achieve this, the company plans to generate inorganic growth through strategic acquisitions that strengthen its position in core markets and expand into high-growth areas. In addition to driving growth, management aims to maintain strong cash flow and profitability by prioritizing operational excellence and cost management. This will enable the company to invest in innovation and expansion while maintaining a disciplined approach to capital allocation. The company's strategy also involves securing participant retirement benefits and minimizing reliance on contributions as a source of benefit security. Management is committed to maintaining sufficient liquidity to pay benefit obligations and cover proper expenses, ensuring the long-term financial stability of the organization. The company's financial activities have been notable in recent times. One of the key developments is its decision to pay out dividends to shareholders. This move indicates a commitment to rewarding investors and distributing profits. Furthermore, the company has also undertaken share buybacks, which suggests a focus on returning value to stakeholders. In terms of specifics, it can be confirmed that the company has indeed paid dividends, as detailed in page 34 of its financial reports. Similarly, the company has bought back shares, with further information available on the same page. These actions demonstrate a proactive approach to managing shareholder interests and maximizing returns. There are several concerns regarding inventory buildup and supply chain disruption that warrant attention. The potential risks associated with these issues include instability in global economies and financial markets, as well as cyclical weaknesses in the industries served by a company. Furthermore, large or rapid increases in the cost of raw materials and component parts can lead to substantial decreases in their availability, causing disruptions in the supply chain. This can be exacerbated by natural disasters, catastrophes, pandemics, or other unforeseen events that disrupt distribution networks. In addition to these external factors, companies must also contend with internal challenges such as inventory buildup. If not managed properly, this can lead to a negative impact on shipping products and meeting customer demand. Overall, it is essential for businesses to be proactive in mitigating these risks and developing strategies to ensure the smooth operation of their supply chains. That concludes the financial summary for Ingersoll Rand Inc. Feel free to comment below, and I will be happy to answer them when possible.